We are now proceeding into a unit of the course that focuses on the general purpose financial statements, and we're going to start with perhaps the most fundamental of them all, the balance sheet. The balance sheet reports a company's financial position as of a single point in time. And that term as of, this is actually what you're going to see in the headings to a company's balance sheet. It provides a snapshot of the company's accounting equation, its total assets, liabilities, and equity, and these are organized based on certain characteristics. So here's our old trusty friend, the accounting equation once again. But this time, we're going to add a different way of disaggregating the framework. Both our assets and liabilities are now going to be split into two buckets, both the current and long-term components of each. Split is what we call a classified balance sheet, and the whole point is to help users distinguish what amounts are going to be turned over quickly versus what items are going to stick around for a while. And this distinction matters a lot for financial statement users that are trying to figure out things like how the company is going to pay its bills during the next year, the extent to which it's invested in long-term fixed assets, as well as its long-term solvency. For the remainder of the video, our focus is going to be on what the definition of current means, and determining which assets are classified as current on the balance sheet. Specifically, current assets are those that a company expects to either convert to cash or consume within the upcoming year, or within the company's typical operating cycle if that happens to be longer than 1 year. And what is an operating cycle? It is the average length of time it takes for a business to turn inventory into cash. In other words, the operating cycle maps out both the time it takes between the purchase and production of inventory to its sale, and the time it takes to collect cash from customers, in particular those to whom we're selling on account. Now think to yourself, if you ran a business, how long would you want to wait to sell your inventory and collect the cash from those sales? Answers may vary, but my guess is you don't want to wait for over a year to do that. As a result, for most businesses, the 1-year rule does work as it relates to classifying assets as current. But for some industries like construction or winemaking or aerospace, the operating cycle is naturally going to be longer than 1 year. Hence, that timeline becomes the cutoff instead. Here, I'm presenting the 5 most common categories of current assets that I'd like you to be familiar with. We've got cash and cash equivalents, short-term investments, accounts receivable, which we notice is expressed as net of a relevant allowance, inventories, and prepaid expenses. Go ahead and take note of the order that these happen to be listed in. While this section of the balance sheet may look different for this or that company, the presentation rule per US GAAP is that current assets should be listed on the balance sheet in order of descending liquidity. As we'll shortly see, liquidity can have a definition both at the asset level as well as for an entire company. Since we're talking about specific assets right now, liquidity refers to the ease with which an asset can be converted to cash without losing its value. So cash itself is sitting on top because it's already cash, and the cash equivalents are such extremely liquid investments, they will certainly convert to cash within even the next fiscal quarter. Prepaid expenses sit at the bottom because they typically get consumed, not converted to cash. So again, in general, what we're looking at here is assets that are most liquid are being presented at the top, and those that are least liquid towards the bottom. Let's briefly discuss each of these 5 categories. First up, we've got cash and cash equivalents, the most liquid of all categories. This includes cash on hand, petty cash, and certain bank account balances like checking and savings accounts. Cash equivalents extends the definition a little further. These are very short-term, highly liquid investments that are readily convertible into known amounts of cash. The benchmark for short-term here is an original maturity of fewer than 90 days. Common examples would include government bonds, commercial paper, money market accounts, and certificates of deposit. In the end, we lump these into the same category because these short-term investments will certainly be converted into cash quickly and with minimal risk of losing value. Next up, we have short-term investments. These are stock and debt securities of other corporations that the company holds, but with a specific purpose. To be classified as short-term, the company has to have both the ability and the intent to sell those securities within the next 12 months. If they're planning to hold them longer than that, they're going to be classified as long-term investments and be bumped down to the long-term assets section. Sometimes these are referred to simply as marketable securities. Now, I think it's worth noting how intent matters here. The same exact share of stock could be classified differently by two different companies, depending on what they plan to do with it. Now let's talk about receivables. These most commonly result from the sale of goods or services to customers on credit, which we call accounts receivable. These are also sometimes called trade receivables because they come from the company's normal trade or business activity. But there are also non-trade receivables, which can result from loans that the company has made to other entities. Notes receivable would be the classic example here. And one last but very important detail. Receivables are presented on the balance sheet net of any relevant allowance. That means the company has to estimate how much of that receivable balance probably won't be collected, and it's important to reduce the reported amount accordingly so the number shown reflects what the company actually expects to collect. Now, inventory. You know what inventory is, right? We're talking about the goods that a company holds for sale to customers. For merchandisers, these are the products that they have purchased from another company and they now hold for resale. For manufacturers, this would collectively include the raw materials, the work in process, and all those things that eventually become those finished goods. Inventory sits on the balance sheet as an asset until the moment a sale happens, and at the time of sale, the cost of that inventory moves off the balance sheet and onto the income statement as cost of goods sold. Inventory is a pretty fun account to work with because there's a lot of different approaches for how we cost these goods as they're being purchased or produced. In other words, their initial measurement. But their subsequent measurement is also really important because inventory valuation requires judgment, and inventory may become obsolete, damaged, or otherwise less valuable in the future. Finally, we've got prepaid expenses. A prepaid expense arises when a company incurs a cost to acquire some future economic benefit in one period that won't be expensed until later. Most of these are going to be current assets, but again, it critically depends on whether or not we expect to consume things like prepaid rent or insurance within a 1-year span. Interestingly, we even consider things like supplies to be among prepaid expenses because at the time you purchase them, they're simply an asset that will be used up over time. It's with that ratable consumption that converts it into a supplies expense later on. And that wraps up our current assets. In the future, we will look at long-term assets, liabilities, and equity, but for now, understanding the current assets portion of the balance sheet is a great start.